Great to have you with us this morning, and we'll be covering the story of the Canadian stock market, which is, as we mentioned, trading right around all-time highs. But when it comes to the Canadian economy right now, we've got some key issues to watch very closely. We mentioned in our newscast that the Prime Minister, Mark Carney, is going to be meeting with steelworkers today and sent that message to reporters yesterday that, while Canada is hoping to get some kind of trade arrangement worked out with the United States, he is lowering the bar in terms of expectations for some kind of deal that does not involve tariffs. And that comes after we just got some news about inflation hanging around and possibly making the Bank of Canada's job fairly tricky. For more on what that all means for the economy, the currency, let's bring in Karl Schamotta, he's Chief Market Strategist at Corpay. Karl, great to have you back with us. I guess on this latest chapter on the trade front, first off, we're waiting for more messaging from Mark Carney today, in particular, directed at the steel industry. But what did you make of his comments, really kind of lowering expectations that we could, get out of this trade situation with the United States without tariffs?
Yeah, I think this was a good dose of realism. I think, the writing is on the wall. It is in the letters that Trump has, been sending out in the sense that overall tariff levels are rising. They are likely to remain, quite elevated relative to where they were at the start of the year. And the Canadian economy needs to adapt to that as a result. All that said, the interesting thing right now is that when we look at the effective rate that's really being charged on, Canada's exports in totality, it's still below the 5% threshold, right? It's somewhere between 2 and 4%. And so, the toll that this is taking on the Canadian economy is very likely not as bad as we had anticipated a few months ago.
And you see that arguably evidenced in everything from some of the housing data to some of the habits of Canadian consumers, which, based on some comparables, are actually more optimistic on spending than Americans right now. But at the same time, the inflation numbers that we saw yesterday were a reminder that for the Bank of Canada, which not that long ago was, pretty committed to cutting interest rates, has had to navigate both inflation worries and where the trade story goes as well. They have a rate decision later this month, especially after the data yesterday. An even lesser amount of Bay Streeters were expecting the Bank of Canada would, make a move on rates. But what's the Bank of Canada's challenge right now, in your opinion?
Yeah, it's great to see the huge pivot that we've seen out there in market pricing. So back at the end of June, we were looking at roughly 40% odds of a cut at the July meeting. That's now plunged to around 5%. And that reflects, all of this relatively positive data, as well as that inflation backdrop, right? If we look at the data yesterday, we saw, the Bank of Canada's preferred core measures moving above the 3% threshold on a year-over-year basis, and the breadth of inflation increases widening, right? So more categories generating more inflation. And so that's certainly not what policymakers want to see. You take that, you add all of the uncertainties that we have around, the direction of tariffs, the direction of fiscal policy in Canada, and, what overall businesses and consumers are going to do about all of this. And, the stage is set here for a prolonged pause. It really makes sense for the bank to sit and wait on the sidelines and, sort of assess data as it comes in over the next couple of months. By September, we should have a much more clear idea as to what's happening in the Canadian economy and where things might head. And at that point, it might make sense for the bank to resume cutting or to, issue a much more, hawkish set of communications and talk markets back from expecting further easing.
All right. Now, we'll see what where the economy lands, what happens with interest rates. The Canadian dollar traders are paying attention to all of that. But we also have to watch some of the trends tied to the U.S. dollar. And I have to highlight that we've got these all-time highs for U.S. stocks. Everybody who was cautious on the America story earlier this year, I'm talking about in the equity markets, they were saying, look around the world, better opportunities, yada, yada, yada. It does seem like there's a lot of cash that's coming back to the USA. What are you seeing in terms of the action in the U.S. dollar, and how does that U.S. dollar loonie story come together?
Right. So the dollar is appreciating. It has appreciated on a month-to-date basis, right? It's coming off its lows quite sharply, and this does seem a reflection of a decline in expectations for Fed cuts, as well as that flood of cash that's headed back into American financial markets. That being said, though, if we look at it from a year-to-date standpoint, the currency effect has been quite substantial. So the U.S. equity markets have technically underperformed most of their global counterparts this year on the basis of the dollar falling. So, although they look very high in dollar terms, they are not so high from a global standpoint. I do expect that, we could see this continue through the summer months. It does look as if, traders and investors globally are sort of downplaying the risk of further turmoil in the U.S. economy. They're still playing the assumption that that Trump will ultimately back off on his tariff threats, and as a result, the U.S. Markets remain the destination of choice for global capital flows. But I should say that that is a major risk. We could be wrong. We could see traders revise their expectations if Trump does follow through on his tariff threats. And the other major risk that is looming over markets is the firing of Jerome Powell. If we do see that happen, that could mean a much deeper decline in the U.S. dollar and a decline in U.S. equity markets in relative currency adjusted terms.